Ladies and gentlemen, welcome back to another episode of Investing for the Common Man. My name is Luke, and I want to help you save both your time and your money. Have you ever looked at a convoluted chart like this and wished you could just see a simple line chart version? Lines are nice, right? They're straight and simple without extraneous noise. We all grew up with line graphs and are really comfortable with them. So why are candlestick charts preferred by most investors and traders? Well, the answer is that a candlestick chart can offer some really useful additional data that you can't find on a line chart, and make it easier to recognize patterns and indicators that traders can use to predict future price action. In this short video, we are going to cover the basics of how to read and understand candlestick charts. In the next few videos, we will cover how to do technical analysis and recognize patterns and indicators that you can use to increase the success rate of your trades. Once you learn how to use a candlestick chart effectively, I can almost guarantee you that you will never go back to the simple line graph. Before we dive in, why don't you take a few moments to subscribe and hit that like button so you don't miss out on those future videos. Alright, let's dive in. These are called candlesticks. A candlestick can represent any period of time from 1 minute to 1 year. But the most common and effective use of candlesticks are on the 1-year daily chart. So for simplicity's sake, I will assume that each candle we see in this video represents one trading day. The anatomy of a candlestick is made up of two parts. This thick part right here is called the body, and the thin part that can appear on one or both ends is the wick. Some people come up with their own terms like shadows or tails, but they all mean the same things. These two parts of the candle convey 4 different distinct pieces of information. The body of the candle represents the opening and closing price of the day. If the candle is green, that means that the bottom of the body is where the stock price opened, and the top of the body is where the stock price closed. The candle is green because the stock went up in value over the course of the day. The red candle, on the other hand, is the exact opposite, meaning that the stock opened up here at the top of the body of the candle and closed down here at the bottom. The wicks represent the full range the stock traded within over the course of the day. That means that the ends of the wicks represent the highest and lowest prices of the day, also known as the intraday high and low. A candle with very long wicks could be an indicator of high volatility. Most traders tend to focus on the body of a candle because the opening and closing prices of a stock are considered to be more significant than any other price that the stock achieves throughout the day, because they are perceived to be the most accurate consensus from the market of the fair value of the stock. Occasionally you will come across a candle like this, one with long wicks but little to no body. This is called a doji and can have special significance when it comes to technical analysis. A doji implies that there was considerable upward or downward price action during the day, but those moves did not last and the stock returned to or within a few cents of the opening price. There are a few different types of dojis, but under specific circumstances they can serve as a reversal indicator where the stock is likely to lose momentum and start heading in the opposite direction. Alright, now you should understand how to read a basic candle. If you struggle with mixing up the opening and closing prices, just remember that candles are green on the up days and red on the down days. The real magic happens when you start stringing candles together in sequence because it unlocks a whole new realm of information and analysis. Let's look at this chart as an example. The very first thing I want you to notice is that some candles do not open at or even near the same price that the last candle closed on the previous day. This is because there are more than 16 hours between the end of one trading day and the start of the next, so often news that affects the price of a stock will come out overnight and cause the stock to gap up or gap down. As you can see right here on this chart, this company announced earnings and beat expectations by over 500%, which caused the stock to gap up and skyrocket the next day. A few days after this breakout, we have a bearish doji where the stock price went up significantly but then returned to the same price that the stock opened at, and this is followed by a change of momentum and direction, which makes this doji an example of a change of direction indicator. You can also draw trend lines on a candlestick chart to identify channels that stocks are trading within. A channel can exist over the course of months or even just a few days, and can trend upwards, downwards, or even sideways. Any good trading software will let you mark up charts and save those drawings so you can reference them later. This will become very valuable when you start learning more about charting skills and technical analysis. Now that you understand the basics of reading a candlestick chart, in the next few videos I will start introducing concepts for technical analysis and how to recognize specific patterns that you can use to predict the future price action and guide your trading. All of the charts that I used in this video today were from the trading platform Webull. I really like this platform, and if you want to try it out, you can use my link in the description below to acquire 2 random free stocks valued between $12 and $1,400. Now, if I could ask one thing of you, please do me a favor and subscribe and hit that like button for the YouTube algorithm. Until next time, keep calm, stay healthy, and happy trading.